Listen-only mode.
Hello, this is Doug Gerlach from iClubcentral. Welcome to our Investment Club webinar. Today is Tuesday, November 17th, 2015. We're going to be taking a look tonight at some of the year-end tasks that you could be doing in your investment club with respect to your club portfolio, specifically taking a look at the fundamentals of your holdings, the overall growth that you can expect from your portfolio, the capital gains and losses that might be prudent for you to harvest at year end, and some of the other tasks that just make this time of year a good time to be looking at your overall portfolio and the tools that we provide at iClubcentral that'll help you with those tasks. Tonight, I'm joined by Russell O'Malley, who is iClubcentral's Club Accounting Advisor. He's a longtime investment club member and a volunteer with Better Investing in the Silicon Valley chapter out on the West Coast. Welcome to the webinar, Russell.
Thank you. Glad to be here.
We're going to be taking a look at something that Russell's club has done. My clubs certainly do, taking a look at these tasks, what I call a portfolio review, which I think is just a good practice. But before we get into that, let's just review our regular housekeeping tasks and remind you that if you are having technical problems with the GoToWebinar platform, to contact them directly at their toll-free number or at gotowebinar.com. If you are having problems, we recommend that you turn off any unnecessary programs that are running in the background, that you don't connect using Wi-Fi if possible, and you can always listen using the telephone, which will free up the bandwidth on your computer for the graphics to be delivered. If you have a question, you don't need a microphone. You can use that GoToWebinar application to type in your question at any time. Russell and I will be monitoring those questions, and we'll answer them during the presentation as well as at the end. New in the GoToWebinar application is the ability for you to download the handout for tonight's presentation from the Handouts tab. So you can check that out right now. Get in the habit of downloading those handouts as soon as you get into the webinar when they're provided, and you can save those, you can print them, you can look at them later if you need to, refer to them however you want to, so they're available there. You might need to expand that handouts panel by clicking on the little plus sign to turn it into a little minus sign if it is already compressed in your GoToWebinar application. But that's the easy way to get those handouts, the PDF file that you can save on your computer and refer to at a later date. Our upcoming webinar schedule is always available at iClub.com. Just click on the Learning tab. You'll see the schedule for the next couple of months. In December, there is no Toolkit 6 User Group webinar due to my travel schedule, but we do have a lunchtime stock club on Monday, December 14th, and then we have a Closing the Club's Books webinar on Tuesday, December 15th. So that is this date, the third Tuesday of December, a month from now, where we'll look at the tasks from the accounting perspective of closing the club's books. So this is something that all treasurers will find useful, help you with the task to get ready for tax season as it comes around the corner. In January, of course, we will take a look at our 2015 Investment Club Tax Preparation Module. And then in February, we'll have a tax clinic, as we've been holding it the last couple of years, to help clubs that have specific problems and answer any additional questions that clubs and club treasurers might have about the income tax preparation process for investment clubs. The iClubcentral Club Accounting Tax Printers are available for pre-order now. You can pre-order them at the lowest possible price at iClub.com. Then they will be delivered to you or made available in your My iClub website as soon as they are approved in the case of the state forms, or as soon as we have the final forms from the IRS, which typically happens sometime in mid to late January for the IRS. And the states, those can sometimes extend into February. but you can go to iClub right now and you can pre-order those tools. There's an early bird price that expires on December 31st. So after that, the price will go up. And if you are a Stock Central member or anyone in your club is a Stock Central subscriber, you can get an additional discount on the ICLUBcentral Club Tax Printer program. So keep that in mind for maximum savings. Finally, you can like us on Facebook for updates about our upcoming webinars and get an announcement when webinars are posted to the archives. So if you ever miss them, that's an easy way to keep up to date with our activities. Just look for ICLUBcentral on Facebook. So let's take a look now at some of my recommendations for the year-end portfolio review. I suggest that November is the right time to conduct your annual portfolio review. Don't wait until December, but take a look in November. When you do that in November, if you are going to sell some stocks that might possibly be held as a loss, you'll have the ability to repurchase them earlier in the year after 31 days have gone by if you wanted to repurchase those stocks after you've sold them for a capital loss and avoid the wash sale rule. But if you wait until December, then you're moving into February. Usually at the start of the year, the market might be going up a little bit. So if you can get in as earlier in the year as possible, you perhaps have a slight advantage in the market. So again, this is when you're selling depreciated stocks. But I think November is a good time to take a look at all of your portfolio, the state of your portfolio before you get into the year-end tasks and the decisions that have to go into preparing the tax returns, all of the work that goes into that. My first tip to take a look at your portfolio is to eliminate meaningless stocks. Your portfolio should be made up of concentrated holdings. I see a lot of clubs that either have too many stocks in their portfolio or they're holding a couple of stocks that only make up a tiny fraction of the overall value of their portfolio. And I have a 3% rule that says no stock in your portfolio should total less than 3% of the total portfolio value. And the reason for that is that even if those stocks perform well, they're so small in your portfolio, they're not going to have an impact on the overall portfolio value. If you've got a holding in your portfolio that makes up 1% of your total portfolio, and that portfolio goes up, doubles in value, that stock rather doubles in value overnight, what's the total impact on your overall club portfolio value? Well, it's only 1% for 100% gain in that tiny position. At least if a stock is 3 or 4 or 5% and it doubles overnight, then you're seeing a significant return, a 3, 4, or 5% return to your total portfolio. But those small stocks can be a real drain on the club members who have to report on them. Sometimes clubs have these shard stocks, these leftover shards of shares that they got as part of a distribution or a spin-off, and they want to, don't know what to do with them, or the positions seem so small that to sell them would actually cost you more in commission. And that's exactly what I'd recommend that you do. Sell them anyway. Just clean them out of the portfolio. Use that money to buy additional shares, or maybe if you like that stock, you should be adding to the position. And again, it's okay if you have a plan over time, if you're investing on a monthly basis, for instance, or a regular basis, and you intend to increase that position. But too often you'll see clubs and investors take a small position, the price goes up, and now they feel like they can't add more shares because it's more expensive. Well, that was the whole idea of buying it in the first place, so why didn't you just take a significant position? So that's keep that in mind, that 3% rule. I think that will really help with focusing your portfolio. When you look at the performance of actively managed mutual funds, the best performing funds are often not the behemoths that have giant portfolios and own hundreds or thousands of stocks. but a small fund that has 30 or 40 or 50 stocks in it, where those holdings are very concentrated, those tend to perform quite well. Surprisingly, the more stocks you own, the greater the chance that your total portfolio is returns are going to regress to the mean, which means they're going to come close to the market average. And we don't want the market average. We want to outperform the market. So let's stick with a portfolio of well-selected stocks, perhaps a dozen, 15, or 20 of them, and in no case less than 3% for any stock in your portfolio. Now, another thing that I like to ask clubs to look at is the growth of their holdings. Let's talk about the trend of growth, making sure that all the stocks that you own are fundamentally strong companies that have good growth prospects. So in Toolkit, we call this the defensive portfolio management, where we review the trends of earnings, sales, and pre-tax profit growth to determine if all the companies that you own are meeting your objectives. So I think taking stock, we should be doing this on a regular basis throughout the year, but if we look at the portfolio as a whole right now, and you look at all of the growth trends for sales and for earnings and pre-tax profit over the last 4 quarters on a trailing basis, you want to make sure that those rates are at least as good as your expectation for earnings and sales growth going forward. And if not, and if those trends are looking poorly, those are the companies that we might consider selling. Sometimes we don't know. Sometimes we are uncertain about the stocks in our portfolio. And again, I think that if stocks have uncertain prospects for future growth, that it's a good idea to eliminate or replace those companies. If you're using Toolkit 6, you can use the portfolio alerts. If you're using the Better Investing tools, you can look at the PERT report. You can look at the PERT report also in Toolkit, although it's a little more complicated than the portfolio alerts in Toolkit 6. Those portfolio alerts will flag the companies and ask you to review the growth rates of the stocks that you own in your portfolio and make sure that the recent trends are in line with your expectations. If they're not, we should be thinking about replacing those companies. Now, another thing to look at is the strength of the growth of the stocks that you own. It's not enough that they have positive trends. The strength of growth means that the growth has to be high enough for all of the companies in your portfolio on average to meet your overall objectives, which should be to exceed the market rate of return. In a growth stock portfolio, the average growth of the stocks that you're holding should exceed 12% annually if you want to exceed the market return, which is over the long term 10 to 12%. So we want to make sure that the average growth is at least 12%. Maybe there's some dividends that will provide a little additional return, but if your returns fall much below 12%, even dividends aren't going to lift it up. You're going to be dependent on the PE ratios to increase to deliver your market-beating rate of return, and that's unlikely right now because PE ratios are so high for most of the market. So we're not going to see a lot of PE expansion in the next couple of years. So we really have to focus on the growth part of our portfolio. So a simple exercise that I like to do is to just capture the analyst's long-term, or either the 2-year or the 5-year growth rates for sales, but let's focus on earnings for all of the companies in your portfolio, and then just average them. You can, if you're an Excel junkie, you could do a dollar-weighted average by the size of the position in your portfolio, but a simple average will give you a rough guideline, a thumbnail of how much your club portfolio might expect to deliver on a capital appreciation basis over the next few years. So in other words, we look at all of the holdings, we write down what all of the long-term growth rates that we expect for earnings, and then we average that growth rate. And when I've done this with investment clubs using analyst consensus estimates for 2-year forward earnings per share growth, you'd be surprised. Some might have an 8%, some might have 13%, but that seems like a small range. But if your club is only expected to grow at 8% over the next couple of years, chances are that you're going to underperform the market. So we want to focus on growth opportunities and get rid of those large companies that are have become dinosaurs potentially in our portfolio. So it's at least it's an interesting exercise for your club to go through and focus on the earnings per share growth potential of the stocks that you're buying. We are growth stock investors, so let's focus on the growth and make sure we're capturing that in our portfolios. So we can also take a look at the...
Tech?
Yes. Yes, Russell.
I have a quick question. When you're averaging them, do you do a weighted average or just an arithmetical average of 12 stocks, 12 numbers, or do you weight them by portfolio value? Stock.
Certainly the easiest way is just to do a simple average, a mathematical average. Okay. If you are a little more conversant with Excel, then I would suggest calculating the weighted average using the value of the stock in the portfolio, and that'll give you that'll help fine tune it. If you have widely disparate positions, so if you've got one stock that's 3% and another one's at 40%, it's the weighted average is going to give you a slightly more meaningful figure. But I think even the simple average method is going to give you some good guidance as to potential in your portfolio. Yep. All right, well, let's take a look at your portfolio balance now. We want to make sure that your portfolio is diversified in two main ways. One is by company size, and one is by industry group. So first, company size. Better Investing recommends that investors in investment club portfolios have 25% of their portfolio invested in small companies, 25% in large companies, and 50% in mid-sized companies. Now, the reason for this is that the small companies give you higher growth, but at higher return, or higher risk, rather. The large companies give you slower growth, but lower risk. And the mid-sized companies are right in the sweet spot where there's above market average growth, slightly more risk, but you add these categories all together, you can really create a portfolio that has an optimal level of risk and reward. So if your portfolio is out of balance, you can look at selling or replacing segments, perhaps in conjunction with some of the things we'll look at next in terms of capital gains and losses, or maybe you just want to set goals to improve your company size diversification. So make notes and say, our portfolio has a lot of technology in it. What can we do? We can either, one, reduce our technology exposure, or two, increase our exposure in other sectors, other industries that might not correlate very closely to technology. On the My iClub website, you'll find the company size diversification graph and report, and the graph will give you something like this. We've updated these graphs so they're a little easier to read now, but you see the company sizes, mid, mega, and large in this case. There's an unknown, there's small, and micro also might be included there. So here in this case, you see there is an overweighting in the mega and large category. I'll talk about the size breakdowns in a minute. This green and gray area, the mega and large on the bottom and right side. And together, they make up a big chunk of the portfolio, almost probably 2/3 to 3/4 of the portfolio. So 75% is mega and large. So where Better Investing suggests 25% would be an optimal level for the size of those companies. So this is just an easy way to view your breakdown. The company report will give you the specifics in it. Now, we are in the process of updating our size guidelines. The Better Investing's size recommendations were last updated 20 plus years ago. And so since that time, the impact of inflation, the growth of GDP has made those size categories a little skewed. So we have some new categories that we're rolling out. We have a micro category that we use on my iClub, which is companies that have revenues below $100 million. The new size category or definition for small companies is revenues below $1 billion, up from $500 million. Then mid-sized companies are between 1 billion and 10 billion, whereas before it was between 500 million and 5 billion. And then large would be greater than 10 billion. So those are being rolled out into the iClub tools as we speak. So right now the site is still using the old definitions. For most clubs, the specific dollar amounts of revenues that we use to determine the size of a company is not nearly as important as focusing on smaller companies than you currently own. So I don't want people to get hung up in the numbers. It's not, you don't get bonus points for matching that optimized diversification allocation that Better Investing suggests, but it gives you something to work towards to capture as much return as you can from the stocks in your portfolio at an optimal level of risk. So this is the company size breakdown, and you can check those out again on my iClub. The second part of checking your portfolio balance is to look at the diversification by sector and industry. And again, if the 3% rule is in effect in your portfolio, that no company is less than 3%, it makes sense for no industry to be less than 3% as well, and no more than 15%. But that is less of a hard and fast rule than a rough thumbnail. Sometimes we will have positions that make up a bigger chunk than 15% in your portfolio, and there are a lot of factors. If you have consumer goods offset by industrials, for instance, or you have consumer non-cyclicals offset by industrials, those will mitigate overweighting in those categories, for instance. So there are a lot of dynamics within the sector diversification in your portfolio. But if you've got, 2 or 3 different sectors or industries that are making up each more than 20-25% of your portfolio, you're probably not diversified enough, and you might want to thin out some of those industries, some of those sectors. Again, in conjunction with your capital gain loss review, it can help you make a replacement decision because, one, it aids in your capital gain loss harvesting, which we'll talk about, and 2, it also helps with portfolio diversification to find other tasks. Again, if you're not going to take an immediate step before the end of the year, you can certainly make this an objective for next year to find companies that help you diversify your portfolio into industry groups in which you're currently not represented or underweighted. And the My iClub sector and industry diversification graph and report also has a graph like this that will show you the industries, the sectors, and the company breakdown. So in this case, you can see there's a consumer electronics company in this portfolio that makes up 47% of the portfolio. That's the main technology holding, and that is skewing this portfolio on the technology side. And that would be Apple, of course. That's a common problem that a lot of investors have, that they're overweighted because of that. Again, we're not saying go out and sell your Apple, but it is something that you want to not add more technology into this portfolio until that percentage gets down to a more reasonable level. The rest of these, the sectors and industries are underweighted or at a reasonable level of representation in this club's portfolio.
Doug?
Yes, Russell.
The graphs for these two, the size graph and the industry sector, have been really helpful for my club. Seeing it visually like this for the reports, it's just the numbers and words and stuff. It doesn't have the impact, but seeing the visuals of this has been really helpful for stimulating my club to really take the diversification seriously.
Yeah, last year when we rolled out an update to my iClub, we put these graphs on the same page as the portfolio reports, so that when you print the report, it includes the graphs. And again, the graphs are the reports are fine with all the detail. But as you said, I think that I would be happy for clubs that would distribute these graphs along with the valuation statement and the member status report, these graphs and these reports, just to remind people about the importance of how all of your holdings work in a diversified portfolio, and to give everyone the signposts that they want.
Yeah, I'm trying to do that at least every 6 months, and I may go to like at least once a quarter or so, since I'm the one who generates these for the club, and just remind people, this is something to take seriously.
Yeah, I think I've seen a lot of, since I've started really pushing the portfolio diversification to clubs, I've seen a lot of clubs that have benefited from this, and they've seen the impact on their overall returns when they focus a little bit more on diversification instead of just randomly buying whatever stock looks most appealing based on which member has brought it in at which meeting, but having a little bit more structure into it. So I think I agree, that this is something that is really important, and we've done a lot to make it more accessible with our tools. Don asks if Toolkit has these graphs. Toolkit doesn't have the graphs, it has the reports, so it has the underlying data. Some of our other portfolio tools, like My Stock Portfolio, do have the graphs, as well as my iClub. So let's take a look now and talk about capital gains and losses. We've talked about this earlier this year, but now it's the time again. And the objective is, even though your investment club is a pass-through tax entity in which the club itself doesn't pay capital gains and taxes, the members do, I still believe that clubs should strive to make their partnerships be tax neutral on a year-to-year basis, thereby passing through essentially a tax neutral status to their club members. And we do that by harvesting capital losses and or capital gains that offset each other in the course of an annual club's operations. The first step is to determine if there are realized gains and losses. Did you sell stocks earlier in the year, so you've got capital gains that are going to be taxed? If so, if you are in that situation, that's great. You've got gains, that's good. You're going to pay taxes. But if you are holding stocks right now at a loss, as we go into the end of the year, it can be a wise move to sell those losers now, even though you may still be optimistic about their long-term prospects, but just to capture the loss, which would offset the capital gain that you've already incurred and realized earlier in the year. Likewise, if you sold a stock earlier in the year and it just wasn't working out, and so you have a capital loss right now, that's fine. It'll get distributed to the members, but maybe the club also has a stock that has gone up significantly in value and now has a lot of unrealized capital gains associated with it, and the club might be reluctant to sell that stock because it would generate capital gains, but it might be wise to sell it before the end of the year, capture the gains that would be offset by the losses already incurred. So again, we have an offsetting of the incurred losses by these new gains. And if you really do like that stock still, you can purchase it. That stock that you've sold at a gain, you could repurchase it right away. There's no rule preventing you from holding off on the repurchase of a stock that you sold to capture a gain. The IRS is fine with that. It's only when you've sold a stock at a loss that you have to observe a waiting period. On My iClub, we have a capital gains journal, which you can review the year to date and see if you've got capital gains, see if you've got capital losses. You may not recall something that happened in February or March earlier in the year. The second step now, if we've got losses, if you've got gains, maybe you don't have any, but maybe you've got stocks that you're holding right now that have unrealized losses or unrealized gains that you might consider selling, even if you've not booked any earlier in the year. Again, selling the losses and the gains at the same time for roughly the same amount will offset the capital gains taxes impact of your portfolio. So check out the biggest losers, the biggest winners in your portfolio. Look at the imbalances that might be there in your portfolio diversification. And again, if you've got stocks that you think have uncertain prospects and you're holding them at a loss, there's really no reason to continue to hold those stocks. We can go ahead and use them to our benefit by selling them and generating those capital losses. The valuation statement and the diversification reports will help you with this step of the process. And then finally, matching them all up, making that final sell decision. And you need to do that before year end if we're going to capture those losses and gains in the 2015 tax year. If you believe that many stocks are at the high end of their valuation range because of the bull market that's going on 7, now 8 years, well, PE ratios are going to be high, and really, where are PE ratios likely to go over the next 2 years and 5 years? At some point, they're going to decline when prices go down, when there is a correction, when there is a bear market. So we might be, if you believe that we're at that high end of the range of valuation, maybe it's a good time to lighten up on some of those positions, some of those high gains that you've got in your portfolio, cash them out, and find other undervalued opportunities that you might be able to find. So matching them up can be a wise move at year end. Here again, your valuation statement shows you the gain and loss. So it's pretty easy to see and spot the percentage of unrealized gain and loss in a portfolio. And real quickly, in this case, if you look, I'll grab my highlighter here. You can see right off the bat, here is a $10,000 gain in this particular holding. Here are a $3,000 and a $7,000 loss for those two holdings. So roughly, you could sell the stock at the gain in this example, O'Reilly Automotive, have $10,000 worth of capital gains, but meanwhile you sell Quality Systems and Suntech Power Holdings, and you generate a $10,000 capital loss. So in the end, you clean out perhaps the undervalued or the underperforming companies, and you get to reduce your exposure to a company that might be more overvalued, capture those gains with really very little impact on your members and on the capital gains basis. In this case, you'd have about $1,000 of, a couple $100 of excess capital losses, which would get distributed to the members, and they could use those losses to offset their personal capital gains that they might have in their portfolios. So when we talk about tax selling decisions, they're often made with temporary intent. So when we say we're going to sell to capture the loss, that is something that is meant to be temporary. It might mean that we still have a long-term optimistic outlook on the company, but the wash sale rule is something you have to keep in mind. When you sell a stock, a security at a loss, you can't repurchase that same security until the 31st day after the sale. So right now, if you were to meet today, this means that 31 days from now, in mid-December, you could repurchase it. But if your club meeting is, perhaps at the beginning of December and you decide to make a sale, that means at your January meeting you might be able to revisit it, and the treasurer, it might be that you would repurchase that stock that you sold to capture the loss at the start of the year. Just make sure that your treasurer doesn't buy it before the 31 days are up. Otherwise, the capital loss or a portion of it becomes disallowed, and you get into a sticky accounting situation, and all of your good work goes for naught. So remember, this doesn't apply to stocks that are being sold with gains. IRS doesn't care about that. You can sell a stock, incur the capital gains taxes, and repurchase it right away if that's what you want to do. But when you're selling to capture losses, you have to keep that wash sale rule in mind. So as you're going through this process, keep in mind your action plan, setting goals for the year, the tasks for the near term for your portfolio. What are you going to do before the end of the year? What are you going to do longer term over goals? So here's some examples. On the left, near term goals: sell stock ABC before 12/31 to capture the gain, sell stock XYZ before 12/31 to harvest the loss, and offset gains from stock ABC. In this case, when those two securities have roughly the same amount of gains and losses. And then review stock XYZ after 31 days to consider repurchase at the January meeting. Often clubs that practice tax loss harvesting have a rule in place that whenever they vote to sell a stock to capture the capital loss, that they always review it in 31 days. At the next meeting, look at the stock selection guide, look at an updated presentation, and consider it automatically for repurchase. Now, they may have been very glad to get rid of that stock that was underperforming and dragging their returns down, but they may also look at it as an opportunity if the stock is still has some fundamental strength to it, to purchase it at a lower price than when they initially did. On the right side would be your long-term action plan: finding replacement stock, finding replacements for stocks with uncertain prospects, increasing small company exposure, or finding more small and mid caps for your portfolio. It could be reducing exposure to the technology sector, or researching additional industries for possible candidates. Looking for many clubs gravitate towards consumer-facing stocks, brand name companies, and they shy away from or don't work hard enough to uncover opportunities to invest in stocks that aren't big name companies but are still viable, attractive opportunities. So that might be part of your action plan for 2016, is to look to exceed, look for additional opportunities outside of your typical sphere of operations. So those are my suggestions for your year-end portfolio review. If there are any questions, please let me know. And Russell, your club does a little bit of this on a regular basis, follow some of these tips, don't you? And you found it to be useful?
Yes, actually, we were doing some last month in our November meeting. We last week, and we were going through looking for overvalued stocks and looking for possible replacements. We, didn't make any decision to sell him. It's hard for us. We had a stock that was automatically sold through a merger. It generated a large gain, but we don't have any stocks. We're lucky we don't have any that have large losses at the moment, so we couldn't balance those off. But we did set a goal. We'll be looking at some other stocks at the beginning of the year, whether we're going to some large gainers that maybe their prospects will be slowing down. They have very high PEs right now. It's been a very good stock for us, so it's kind of hard. People don't want to get rid of it since it's done so well, but we're looking at that. I did also want to bring a comment about the mid-cap stocks. The Northern California BI chapters are doing some webinars, and one of the last ones with Craig Bramer, he brought out some new research on mid-caps that they're sort of a sweet spot in that they get a risk profile of large companies, but growth profiles of small companies.
Hmm. Yeah, that's very interesting. I know Craig is with the San Francisco chapter there, and he's
Yes.
actually a stock analyst professionally. Yeah, that's been my understanding, and it's interesting I'll be interested to see the research that supports it. Certainly in our small cap informer newsletter, we were covering some companies that are more mid cap than small cap, but we're definitely on the smaller end of the scale, and the challenges there are that increased volatility and increased risk profile. But the mid cap is where I think if clubs would focus more on mid-sized stocks and get away from the large company stocks, they would probably reap the benefits in pretty short order. So that's really interesting. Well, if there are no questions, I guess we'll wrap up our webinar tonight. I want to thank you all for joining us. Like I said, we'll see you in December for our Closing the Books webinar. We'll take a look at the tasks that the treasurer and the club should accomplish at year end, just to tidy things up, make sure that everything is accurate, and get ready for the club audit and the club tax return preparation, which will follow in January and February.
Doug, we got one last question here.
Yes.
On Benjamin asking about stocks that pay dividends and the importance of that.
Well, what do you think? How important is it to purchase stocks that pay dividends, Russell?
Well, it kind of depends on your goal. I mean, if you're getting older, I actually am getting a bit older, and my wife's going to be retiring, so we're thinking of more stocks that pay dividends for income in our retirement. But I really still skew towards growth stocks, and growth stocks at a good price. So it really has to do with your personal risk taking evaluate what risk you have, and your goals for your investing, really.
Well, I think the emphasis on dividends is something of a relic. When you look at the market returns in the first half of the 20th century, through the 50s, 60s, the amount of the overall total return that came from dividends exceeded, 4.5, 4.8% on average. But today, it's impossible to get a 4% dividend yield from a high-quality company. You really have to take on a lot more risk in order to capture a yield that's at that rate. And by risk, let's not forget that the risk of underperforming the market is also a risk, not just the risk of losing capital. So if you're chasing dividends, you are taking on you're taking on more risk because companies that have high yields tend to be companies that are struggling, or you're accepting a lower rate of return as a result of investing in a higher yield opportunity. Our investor advisory service newsletter, we have now there are 2 real estate investment trusts, so those have 5 to 6% yields, and the ones that we select have some growth opportunities behind them. But for the most part, the rest of the stocks in the portfolio don't have dividends at the most 3.2, 3.4%, something like that. By and large, dividends are not a big part of a growth stock approach. They might tip the balance for large companies that you own that are slow growing. But remember that over time, if your portfolio is going to go up in value, that's going to come from the growth of the company. Companies that grow their earnings will see their share prices grow up over time. Companies that are paying out dividends on a regular basis are not going to see their returns as high as companies that are in the growth phase of their life cycle. Now, having said that, with interest rates non-existently low, there is already some demand for even meager yields of stocks. In the second half of the 20th century, though, the amount of yield of return in the S&P 500, the overall market that came from dividends, was 2-point-something%. That value, I think, is still around that level for the S&P 500 today. So, I don't hate dividends, but if you have a growth stock approach, you don't want to be chasing yield. You really want to be focusing on growth in the companies that you own. That's my take on it.
I would put, if you're looking for, if dividends, you want to use dividends as a criteria or something to take into account, I think it would be better to look at, has the dividend been growing over time? I've seen some comments about companies that consistently grow their dividend, their stock price also consistently grows, and they actually do tend to outperform the market a bit.
Yep.
But it's not just that they're paying a dividend, it's that they've been able to grow their business enough that they can increase their dividend consistently.
Yeah, it's like the S&P dividend aristocrats. Is that something like they require stocks that have been increasing their dividend for 20 years or more, or something like that. So yeah, growth of dividends is something to look at, and the payout ratio I would pay attention to. And again, it's not incompatible with the growth stock approach that clubs are often using. But again, I think chasing dividends in an investment club portfolio is just wrong. I'd much rather be going for growth with the lower tax implications of capital gains that come from investing in stocks and paying the taxes on them rather than paying taxes on the dividends on a regular basis. If you have members that like dividends, well, that's what your personal portfolio is for. And so I would suggest that clubs remember that their club portfolio doesn't have to replicate what individuals in the club are investing in. It should be its own entity with its own objectives. And every investor, no matter their age or risk tolerance, could benefit from the equity exposure that a typical investment club provides if that club is focusing on growth.
And I agree. All of my portfolios skew towards growth rather than dividends. Dividends tend to be incidental. If they're there, oh, that's very nice, but I'm looking for more for growth.
All right, well, I guess we'll wrap it up there. Well, thanks a lot, Russell, for being with us tonight. We'll look forward to seeing you back in December.
Oh, you're welcome.
And thanks to everyone who turned out. Please feel free, there's my email address. If you have any comments or suggestions or other questions, please let us know. And otherwise, we'll look forward at seeing you at our next Investment Club webinar.